Welcome to the Explainer. So, if you've been watching the ticker tape lately, you knew things have been completely wild. Today, we're going to decode the chaotic June 2026 market shock. We'll discover why what we're witnessing right now is absolutely not a blind panic, nor is it the popping of a massive bubble. Instead, it's a profound structural rotation of capital. Grab your notes because we've got a lot of ground to cover. Here's our roadmap for today. We'll be looking at the June market shock, echoes of the Nifty 50, an AI infrastructure reality check, how the old economy strikes back, macro and global fractures, and finally, we'll tie it all together in The Great Rotation Explained. All right, Section 1, the June market shock. Let's dive right into the scene of the crash to understand the immediate symptoms. Consider these absolutely brutal numbers. The Nasdaq dropping over 2%, and doing that for its sixth straight daily move of greater than 1%. The S&P 500 took a major hit too, but dig a little deeper into the sector rotation. While information technology was bleeding, dropping 3.7%, consumer staples actually gained 1.8%. So, money isn't just evaporating into thin air here. It's actively moving, seeking the safety of everyday consumption. Chronologically, this whole shockwave didn't actually start in Silicon Valley. It began way over in Asia. We saw this massive 12% overnight plunge for heavyweights Samsung and SK Hynix, and that huge drop basically built a bridge of capex anxiety. Customers started complaining that AI technologies were just getting way too expensive, sparking fears of capital expenditure limits. Then, boom, that wave crashed right onto U.S. shores, ending in tech capitulation, with major players like SanDisk dropping a staggering 13.6%. And that brings us to a really crucial point. The core vulnerability we're seeing right now isn't necessarily about broken fundamentals. It's about extreme concentration. Simply put, way too much capital was chasing way too few semiconductor and AI names over just a short 6-month window, and the market simply suffocated. Moving on to Section 2, Echoes of Nifty 50. Let's anchor ourselves with a little historical parallel to process this volatility. When we look back and compare the broad Nifty 50 of the early 1970s to today's narrow Magnificent 7, the patterns are honestly kind of striking. Back then, the Nifty 50 were viewed as these buy and never sell stocks, right? Sound familiar? It's exactly how people have been treating today's indispensable AI hyperscalers. Both groups hit incredibly aggressive valuation peaks before suffering some seriously brutal pullbacks. The big takeaway here? In the short run, sentiment usually trumps value, and in today's hyper-liquid trading environment, it is incredibly easy for investors to just abandon a theme the absolute second it starts lagging. Section 3, AI infrastructure reality check. Let's talk about the very real cost of infrastructure. So, the hyperscalers are no longer just printing money on pure hype. The real-world costs are piling up fast. Get this. Legacy tech giant Oracle is actively cutting 21,000 jobs. That is 13% of their entire workforce, just to fund their piece of the AI arms race. Meanwhile, rising stars like Cerebras Systems are seeing their margins absolutely crushed under the weight of scaling demands, which is delaying their profitability all the way out to 2027, despite massive revenue growth. The human and margin costs are hitting balance sheets really hard right now. But wait, before we write off tech entirely, let's look at the history. Since 2011, there have been 17 similar episodes of a greater than 6% single-day drop in semiconductors. And guess what? Over a 6-month horizon, buying those dips has offered a massive contrarian signal, a 94% win rate and a 39% median gain. Because 2026 has been a strong year for corporate earnings overall, there is actually structural room for the valuation multiple to expand once all this dust settles. Section 4, Old Economy Strikes Back. This is where tangible assets are winning. Okay, I want you to consider a massive number right now. 176. Specifically, 176 megawatts. To put that into perspective, that is enough continuous energy to power roughly 150,000 homes. That's essentially an entire city. So why does that number matter? Well, because 176 megawatts is the exact amount of premium 15-year nuclear power that retail giant Walmart, yes, Walmart, just secured from Constellation Energy. This is a huge power pivot. Nuclear energy's future isn't just about feeding AI data centers anymore. Traditional, real-world retail titans are aggressively stepping in to lock down grid independence and secure their own carbon-free power pipeline. We're also seeing the old economy actively extracting some hidden value from within. Take FedEx as a prime example. They strategically spun off their freight business on June 1st to optimize their core network. Now, at a glance, their shares initially fell 6%, which looks pretty bad. But actually, scratch that. It was just because the spinoff lowered their baseline share price when investors received the new freight shares. The underlying reality is they actually beat Wall Street forecasts with incredible pricing power and network optimization. It was just temporarily masked by the spinoff math. And in a deeply ironic twist, right as the old economy is physically asserting its dominance with nuclear deals and logistics, the ultimate blue-chip industrial index, the Dow Jones, kind of capitulated. To keep up, they literally swapped out traditional telecom Verizon just to let the high-tech giant Alphabet into the club. All right, Section 5, Macro and Global Fractures. Let's look at the hidden economic drags happening behind the scenes. To really grasp this great rotation, we have to look totally beyond corporate balance sheets. Right now, the U.S. economy is facing a foundational stress test with the Supreme Court case Trump v. Cook. We're looking at this purely through an impartial economic lens here. The case centers entirely on whether the president has the constitutional authority to fire a sitting Federal Reserve governor, in this case Lisa Cook, without the traditional for-cause due process. Looking at this clinically, the economic mechanics of such a ruling create a really dangerous system loop. Step 1 is the catalyst, the Supreme Court actually granting that termination discretion. That leads to Step 2, the crack, where the wall of political independence at the Fed just shatters. Then Step 3 is the reaction, where public confidence that the Fed is acting purely on economic data totally evaporates. And finally, Step 4, the consequence. This is where inflation expectations become completely unmoored, making high inflation nearly impossible to manage. The market is aggressively trying to price in this exact risk. And globally, this domestic volatility is compounded by fractures literally all over the map. Over in Europe, an inflation-driven frugality epidemic has led to stagnant regional growth. Down in the Mediterranean, geopolitical tensions have seriously disrupted shipping logistics, hitting companies like Carnival Cruise hard. And looking east, we see the yuan sanction shield, where Tehran and Moscow are successfully using China's yuan-based financial architecture to completely bypass US dollar controls and evade Western sanctions. It is a highly complex, fragmented global picture. Finally, Section 6, the Great Rotation Explained. Let's break down the actual mechanics of this shift. Let's synthesize everything we've uncovered in this explainer into a clear, unified executive takeaway. The June shock was absolutely not the popping of an AI bubble. It was a violent, structural reallocation of capital driven by 3 distinct pillars. Pillar 1, the AI infrastructure tax. Tech is taking a breather as the massive costs of building AI become very real. Pillar 2, the old economy premium. Capital is migrating to tangible assets, logistics, and physical energy security. And Pillar 3, an unmoored macroeconomic base. Markets are grappling with fractured global trade and the very real threat of a highly politicized Federal Reserve. Which leaves us with this final thought. The era of easy, highly concentrated tech gains has hit the pause button. The rules of the board are changing right in front of us. So you really have to ask yourself, how is your strategy positioned to not just survive, but actively thrive in this violent structural reallocation of capital? Thanks for joining me on The Explainer today, and keep your eyes on the data.